Welcome! In this video, we'll break down the essentials of companies, what they are, how they work, and why they matter. A company is a separate legal entity, meaning it exists independently from its owners. This separation provides unique advantages, such as limited liability for shareholders and the ability to raise capital by issuing shares. Throughout this video, we'll explore key terminology, the types of companies recognized by law, and the basic principles behind forming and running a company. Whether you're a student, entrepreneur, or just curious, you'll gain a clear understanding of the company structure and its significance in today's business world. Let's get started by defining some core concepts and setting the stage for deeper exploration. To truly understand companies, it's important to get comfortable with some key terms. Words like shareholder, dividend, capital, and reserves will come up often. Shareholders are the owners of the company, holding shares that represent their stake. Dividends are portions of profits paid out to shareholders. Capital refers to the funds invested in the company, while reserves are profits retained for future use. As we move forward, keep these terms in mind. They form the foundation for understanding more complex company operations. By mastering this vocabulary, you'll be able to follow financial statements, company announcements, and legal documents with much greater confidence. The 2008 Companies Act is a cornerstone of company law in South Africa. It sets out the rules for forming, operating, and dissolving companies. The Act introduced several new types of companies and modernized many procedures, making it easier to start and manage a business. It also emphasizes transparency, accountability, and the protection of stakeholders. Understanding the Act is crucial for anyone involved in business, as it governs everything from share issuance to directors' duties. In the next scenes, we'll look at the different types of companies allowed under this Act and what makes each unique. Under the 2008 Companies Act, several types of companies are recognized. These include private companies, public companies, non-profit companies, and state-owned companies. Each type has its own requirements regarding shareholders, directors, and reporting. For example, public companies can offer shares to the public and are subject to stricter regulations, while private companies have more flexibility but cannot raise funds from the general public. Non-profit companies focus on social objectives rather than profit. Knowing the differences helps you choose the right structure for your business goals and ensures compliance with legal requirements. Forming a company involves several key steps. First, you'll need to register the company with the Companies and Intellectual Property Commission, CIPC. This process includes choosing a unique name, drafting a memorandum of incorporation, and appointing directors. Once registered, the company becomes a separate legal entity, able to enter contracts, own property, and incur liabilities. The formation process ensures that the company operates within the legal framework and provides protection for its owners. Understanding these steps is crucial for anyone looking to start a business or participate in company management. Companies need capital to operate and grow. This capital can come from issuing shares to investors or borrowing funds through loans and debentures. Share capital represents ownership in the company, while loans and debentures are forms of debt that must be repaid. The way a company raises capital affects its financial structure and risk profile. Investors look at these details to assess the company's stability and growth potential. In the next scenes, we'll explore how companies issue shares, handle dividends, and manage their reserves. Shareholders are the backbone of any company. They invest capital and, in return, receive certain rights. These include voting on key decisions, receiving dividends when declared, and sharing in the company's assets if it is wound up. However, shareholders do not manage the company directly. That's the role of the directors. Shareholder rights are protected by law and the company's constitution. Understanding these rights helps investors make informed decisions and ensures fair treatment within the company structure. Reserves are an important part of a company's equity. Retained income, or retained earnings, represents profits that are kept in the company rather than distributed as dividends. These funds can be used for expansion, paying off debt, or weathering tough times. Other reserves, like revaluation surplus, arise from changes in the value of company assets. Some reserves are distributable, meaning they can be paid out as dividends, while others are non-distributable and must remain in the company. Understanding reserves helps you interpret a company's financial health and future plans. Dividends are a key way companies reward their shareholders. However, dividends are not automatic. Directors must declare them, and the company must pass the solvency and liquidity test to ensure it can pay its debts. Once declared, a liability is created, and payment is made to shareholders on record as of the last day to register. There are interim and final dividends. and the process involves several accounting entries. Dividends are recorded in the statement of changes in equity, not in the profit or loss statement. Understanding the dividend timeline helps shareholders know when to expect payments and how they're accounted for. Companies are subject to income tax on their profits, currently at a rate of 27% in South Africa. Taxable income is calculated by adjusting accounting profit for exempt income and non-deductible expenses. Dividends tax is a separate withholding tax, usually 20%, paid by the company on behalf of shareholders when dividends are distributed. However, dividends paid to South African resident companies are exempt from this tax. Understanding how tax is calculated and recorded is essential for accurate financial reporting and compliance. Companies must prepare financial statements in accordance with International Financial Reporting Standards, IFRS. Key statements include the statement of profit or loss, statement of changes in equity, and statement of financial position. These documents provide a transparent view of the company's performance, equity changes, and financial health. Accurate financial reporting builds trust with investors, regulators, and other stakeholders. In this scene, we'll look at how these statements are structured and what information they reveal about a company. A company can buy back its own shares, creating what are known as treasury shares. This is only allowed if the company passes the solvency and liquidity test. Share buybacks can strengthen share value by reducing the number of shares in circulation, increasing earnings per share, and rewarding investors. Treasury shares do not carry voting rights or receive dividends. Understanding the reasons and effects of share buybacks helps investors interpret company strategies and their impact on shareholder value. We've covered the essentials of companies, from their legal structure and key terminology to funding, reserves, dividends, taxation, and financial reporting. Understanding these concepts is crucial for anyone involved in business or investing. Companies are dynamic entities that play a vital role in the economy, offering opportunities for growth, investment, and innovation. By mastering these basics, you'll be better equipped to analyze companies, make informed decisions, and participate confidently in the business world. Thanks for watching, and don't forget to review these concepts regularly to stay sharp.